You're listening to Capital Topics, episode number 84. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In today's episode, we discuss crucial components of investing, which are risk tolerance and risk capacity. Enjoy! Good morning, James. How are you today?
I'm great, François, and how are you?
I'm good, thank you. So today we have a topic we wanted to tackle for a long time, and we finally get to it as PWL Capital is launching its new risk profiling tool. Risk profiling is a key regulatory requirement to establish suitability for client portfolio. And I'm sure a listener will find this topic very useful as we believe it will help them think about how their portfolio is structured and whether they may need to make changes. So let's get right into it.
Okay, François. Well, as portfolio managers, we must ensure that we implement portfolios that are suitable for our clients. We go through a process of getting to know them that involves asking a lot of questions in a discovery meeting, and then we ask them to complete a risk profiling questionnaire. Armed with all that information, we're then able to develop a proposed portfolio that is appropriate to help them reach their goals. I would add, François, that I believe that this is a really important skill set that we bring to clients, and it really adds value to the relationship.
I completely agree, James. So what does the risk profiling involve? Can you elaborate on the steps you go through?
Well, absolutely, François. Risk profiling has three components, and there's two to it, and each is a different type of assessment. So the first one is we have to assess the investor's ability to take risk. So this notion of risk capacity. And secondly, there's in an investor's psychological makeup, their behavioral loss tolerance in the jargon. And then finally, an investor's need to take risk.
Okay. So can you explain the first component, investor's ability to take risk?
Well, an investor's ability to take risks includes their time horizon, their potential need for liquidity, mostly short term, the value of their human capital, and their risk capacity. So this involves us assessing the client's financial ability to handle risk. So if they have a big loss, can they cope with it? These factors will determine the investor's financial ability to withstand declines in their portfolio values. The ability to take risk can often be a limiting factor when considering an investor's need for risk to meet their goals.
For time horizon, the longer you have, the more time you have to recover from inevitable bear markets. I would add that retirees can have very long time horizon, even over 20 years. Even if you retire at 65, your investing journey is likely still to be very long.
I agree, François. And we'll talk about that a little bit later for retirees in more detail. Time horizon is a major factor, especially because you may not want to be over-allocated to bonds. Again, bonds are the stabilizer or safe bucket in any portfolio, reduces the ups and the downs. But we know that over the long term, inflation eats away at the real value of bonds. We covered this topic on our podcast when we discussed Professor Cederberg's research about how the so-called safe bucket assets of bonds will not provide protection against inflation. So we recommend our listeners who would like to know more go back to our podcast number 61 to review what we discussed and his insights.
Mm-hmm. James, another element of assessing an investor's ability to take risk is the value of their human capital. What do you mean by that?
Well, quite simply, François, it's the investor's lifetime capacity to earn income from working. Some have very stable cash flows, while others may have less stability. This relates to future capacity to save and therefore build a larger nest egg for retirement. For some investors, the value of their human capital continues well past their retirement as they continue to earn employment income. That is often a personal preference to continue working. So often, like we have clients that are independent financially, but they want to stay engaged. And that's really what research shows, that people want to make a difference. They want to know that they matter, they continue to matter to other people. And so that's why they continue to work.
James, a long-standing belief is that younger investors have more human capital value. Their total future earnings are much larger than their investment portfolio. By contrast, a retired investor who is not working is presumed to have a limited human capital value. Human capital can be considered as a bond-like investment. So the high value of young investors' human capital can justify a higher allocation to stocks.
Oh, so that's pretty standard thinking. And it's mostly true, but I don't 100% agree with this type of thinking. When you look at the long-term benefit of compounding returns, well, let's use a young investor, for example. If they take big risk with a small portfolio, but they lose that capital. But if you measure that over the very long term by not being diversified, then the actual impact of a major loss on what they're going to ultimately accumulate as total assets 40, 50 years down the road, this could be very large.
Yeah. Conversely, James, we have clients over 75 who will never run out of money and therefore have a risk capacity and risk tolerance that to have a riskier portfolio. Their thinking is usually about leaving a larger estate. And now let's tackle risk capacity. Our practice is to do a detailed balance sheet for clients. This is a great starting point for assessing risk capacity.
Absolutely, François. It's one of our disciplines in our team. We prepare that balance sheet, but I often share with clients that it's like going to see your family doctor to get a health assessment. The doctor is likely to suggest doing blood tests, and with the lab results, he can give you a lot of feedback. Well, the personal balance sheet for us is like the blood test. We can get a lot of insights from the data to help our clients, based on the information we see.
Now, James, can we discuss the second component of a risk profile and investor behavioral loss tolerance?
That's why you know the old saying, an investor really learns his risk tolerance in bear markets. So we produce a table that shows our model portfolios and returns pre-fees over the last 20 years. And we walked clients through that table to make sure they see, okay, there are periods that can be very negative, and will you stay the course? So the worst period in the last 20 years, ending December 31st, 2025, was actually during the great financial crisis. So March 2008 to February 2009. And a balanced account, so that's 60% stocks and 40% bonds, dropped about 20%. And an assertive portfolio, it's riskier, 80% stocks and 20% bonds, went down about 27%. So again, we use this table not only at meetings for new clients, but at annual review meetings, because many clients have become accustomed to much higher actualized returns than what we expected in the last 10 years. And as you know, François, we've discussed this a lot in recent podcasts. This really reflects, we've had 3 years, 2023, 2024, 2025, that generated double-digit returns in stock markets. And this doesn't happen often in capital markets.
So the question is, will you stay the course or sell out? If you fear that you may panic and sell out, then you should reconsider your allocation to stocks. For our listeners, you can find all of this information on model portfolio performance history. We'll provide a link to it with the podcast.
Yeah, and I would add, François, this is why it's so important for us to get risk profiling right. We want to make sure clients stay the course during, market downturns. So the best practice in the industry is to use a psychometric tool. And as you stated earlier, François, at PWL, we have a new questionnaire that is designed to assess a client's emotional comfort with volatility. It also provides, very interestingly, a financial psychology profile. So it's a very useful tool.
Right. The right allocation is the one that the investor sticks with for the long term. If during a bear market, an investor sells out and panics and waits on the sideline until they are comfortable to get back in, well, they're at serious risk of reducing their long-term returns. The third and final component of the risk profiling that you mentioned before is to assess an investor's need to take risk. For example, if you're a multimillionaire and you only need $50,000 to live off annually, you may not need to take on unnecessary risk in your portfolio. On the other hand, if you have assets that are limited, you may need to take on more risk to achieve your financial goals.
Well, this part of risk profiling requires we do financial planning. And in our practice, the process is, as we discussed earlier, we get to know them really well. We discuss their investment goals. We have their balance sheet. So for accumulators, we're trying to estimate the amount of savings required to reach long-term goals for financial independence. For retirees who are in decumulation mode, we are planning to find a sustainable withdrawal rate. So we input all this data, the client's balance sheet information, and then we make key assumptions, and we vet those assumptions with the clients to make sure they're comfortable with them. And finally, we prepare, the financial retirement projection. But again, we're, very detailed, beautiful graphic charts, and then backup tables with the numbers. We use a new software platform called Conquest, and it's been going really well with clients.
Mm-hmm. One of the key assumptions that you make in these projections is the expected return on investment and inflation. Our regular listeners know that PWL produces twice a year a guide on financial planning assumptions that gives our estimates of expected return. In that report, you can find a matrix table that covers the whole range of portfolio allocations from 100% bond allocation, the safest portfolio, measured by volatility, to 100% in stocks, the riskiest portfolio. We also reviewed a report with Raymond Cruzeiro, who is the lead author. The plan is to have him on the podcast in July. Listeners can also review our podcast number 79 when we reviewed last year's estimates for expected returns.
Yeah, so François, I'll go on to say that we with this software that we're projecting the retirement, financial scenarios, we simulate different allocations and the corresponding expected returns. The main projections are linear, so it assumes that stable expected return is going to be earned every year, but that's not real life. We also produce with the software a Monte Carlo simulation, which is a statistical model that simulates 1,000 scenarios with random sequences of returns, and that gives us a score that gives us a comfort level that the client, based on the score, will or will not run out of money based on the assumed burn rate and expected returns and longevity estimates.
Right. James, what should retirees do for their allocation? The perception is that at retirement, you must reduce the allocation to risky, volatile investment. Does that make sense for everyone?
Well, that's really, again, standard mindset. Oh, I'm about to retire. I got to make my portfolio less risky. So the answer is yes and no, François. Now, first off, they should go through the whole process of reassessing their risk profile as we outlined in this podcast. Most often clients do not change their risk profile at retirement, but that's mainly because there's got a long longevity as assumed, and so they require a rate of return to protect themselves against inflation. And again, they may have 30, 35, maybe more years ahead of them. But one thing I would add is that there's a general rule of thumb is that at retirement, you should always make sure you have like a minimum of 5, and in many cases, 10 years of your burn rate in your bond or your safe bond allocation. And this rule really will allow investors to avoid selling stocks at rock bottom prices after major market declines.
That's great advice, James. Now let's look at the field of neuroeconomics, which is developing a lot of research delving into how the brain changes financial decision-making as we age.
Yeah, François, well, this research is really insightful. And I came across a research paper published by Camilla Kunin, who's a professor of finance at the University of North Carolina. And her paper addresses how the brain changes across the lifespan.
For listeners, neuroeconomics is a field that combines insights from neuroscience, psychology, and economics. Research has revealed that financial decisions are shaped by three broad forces: the environment people find themselves in, the experience they have accumulated, and the biological changes that come with aging.
François, at the core of Professor Cunan's work is a simple idea. The brain systems that support learning, valuation, and risk assessment are not static. They evolve over time, and those changes systematically affect our financial behavior. She highlights that three interacting brain systems play a central role in financial decision making. One system responds strongly to rewards and positive surprises, encouraging exploration and risk taking. Another signals potential danger and uncertainty, promoting caution and avoidance. And then a third integrates information, supports learning, and helps regulate emotions to guide strategic choices. So what's really interesting is that our research shows that these systems allow people to learn from, their investing experience, their gains, their losses, and then they can estimate what the future outcomes are likely to be, and then they can assign a relative value to the financial opportunities that they're faced with. But their functioning depends on age, and this is the key conclusion, is that as the brain changes, so does the quality of financial learning, and with it, financial well-being.
What I find interesting is that the aging affects the brain's ability to learn from experience, particularly in an environment that requires updating beliefs about uncertain outcomes. Exactly the kind of environment investors are faced with.
Exactly. And among her major findings is that older adults perform just as well as younger adults on tasks that do not require learning from feedback. But when decisions depend on tracking outcomes over time, such as figuring out which investments are paying off or performance declines, she states this is not because older adults are less intelligent or less careful, but because their neural systems that encode feedback become noisier.
Yeah, and in practical terms, this means that older investors are more likely to make mistakes involving misunderstanding about which financial options are truly better. Professor Cunan believes these mistakes are more often risk-seeking errors rather than excessive conservatism, challenging the common belief that aging automatically leads to lower risk tolerance.
Well, exactly. And that's what we've seen in our client base. I've got over 30 years of experience. PWL is celebrating its 30th anniversary this year. And I don't see people, once as they age, their risk tolerance change all that much. So this is significant for risk profiling assessments that we do for clients. And I want to share a quote with our listeners from her article. The underlying issue is that the brain's reward systems becomes less precise at tracking outcomes. Signals that once clearly distinguish good from bad investments grow harder to interpret. Over time, this makes it more difficult to learn from market feedback.
Mm-hmm. James, her research also shows that while learning clearly changes with age, preferences themselves are more stable than many assume. What can you add to this?
Well, she states that evidence on age-related changes in risk tolerance is really mixed. Some studies find that financial risk-taking declines later in life. Others find little change. In the end, she says it all depends on how risk is measured and whether life cycle factors such as income needs or portfolio constraints are taken into account. So her research suggests that observed portfolio choices often reflect circumstances rather than really deep shifts in preferences.
James, another Professor Cunan's finding is very useful. Where age does matter significantly is trust. Older adults are more likely to perceive others as trustworthy, even when cues suggest otherwise. She states that at the neural level, warning signals that normally trigger caution in risky social situations are muted. This helps explain why older adults are disproportionately targeted and victimized by financial fraud.
This, François, is a major consequential age-related finding, and I quote her again, and this is really, really significant. Fraud susceptibility is not simply about education or vigilance. It reflects changes in how the brain processes social risk.
It's not all bad news about aging. She also believes that it would be a mistake to conclude that aging simply degrades financial decision making.
Yeah, François, her research conclusions are really much more nuanced. And so that's a good point you make. She also concludes that many older adults do not exhibit these typical learning deficits. She states that older adults often outperform younger ones in managing emotions, avoiding what she calls sunk cost traps. So you're chasing after bad investments and making it worse, and maintaining discipline during stressful situations. So older adults do have some advantages, and experience matters, right? Wisdom, so to speak.
Yeah, in summary, James, we can say that the key insight from her research in neuroeconomics is not that older adults are bad decision makers, but that they learn differently and respond differently to information. Financial advice that ignores this reality risks being ineffective or worse, harmful. James, where does investing experience come into play when doing risk profiling?
A great question, François. The more experience an investor has with capital markets, the more likely they are to understand that uncertainty is not a bug, but a feature. They will have lived through so many bear markets that they learn to tune out the noise. Loss aversion is a very powerful emotion. For many people, uncertainty is something to avoid at all costs. David Booth of Dimensional wrote a great article back in July 2024, and the title of it was The Value of Uncertainty. And I quote him, "Since we know risk is unavoidable in it, but it's the source of investment returns, you want to find the amount of risk that is right for you."
Yeah, that's a great quote, James. Investors need to remember that markets have prospered despite the dot-com bubble, terrorist attacks on 9/11, the global financial crisis in 2008, 2009, and the pandemic. However, the key to navigating through these difficult periods of the market is to have a plan that properly reflects their risk profile. On that, I think we can conclude today's podcast.
Very well said, François. Great conclusion.
All right. So thank you, Jane, for sharing your thought and expertise again today.
My pleasure, François.
So that's it for episode number 84 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on March 18th. In the meantime, make sure to consult Capital Topics website for our latest blog posts. Thank you, and see you soon.